Hey guys, what's up? I'm Erin and welcome back to the channel. If you've been a stock market investor these past couple of years, there's probably a reason to smile. Back in 2023, the S&P posted a return of nearly 24%. This year, the S&P is looking like it's returning just under 30%. And this can feel like the golden age of investing. But as we zoom out on this exceptional run, the next question becomes, what's next for 2025? Let's dive into the numbers, the trends, and the history to see what might be around the corner. Now, as to why I'm making this video, let's go back a little bit in time to the start of 2023, where we had just wrapped up a rough market year. In 2022, the S&P, the NASDAQ, and the Dow Jones were all overwhelmingly down. And in response to that, I made a video talking about how back-to-back negative years are incredibly rare. Which they are. Since the S&P index was invented, there have only been 18 times where the S&P reported negative years. And in 80% of those instances, those negative years are followed by a positive year. Negative years happen, but historically speaking, they have been far less frequent than positive years, which again is all good news for us as investors. And hindsight being what it is, we were very fortunate that 2023 ended up being a very positive year. A very positive year followed that very negative year, so the traditional trend continued. But now we have the opposite of that. Now we have back-to-back very positive years. That's assuming the performance of the S&P holds for the next 2 weeks. And now we have a new question. That question is, what happens, traditionally speaking, from a historical standpoint, when we have back-to-back positive years? Well, the odds of having 3 years in a row of back-to-back 20+% positive returns is not very likely either. In fact, this has only happened once in the past. It was actually quite a long stretch, 1995 through 1999, which ended with the dot-com bubble. In that situation, we ended up breaking the mold in the positive direction, only to be followed by breaking the mold in the negative direction by having 3 back-to-back negative years. I don't really think that statement comes across as all that surprising. I don't think we can anticipate 20+% returns on a regular basis. The fact of the matter is, we traditionally hear that the stock market averages about 10% a year, and those numbers are posted prior to inflation. And this number isn't indicative of how the market performs on any given year, but rather when you zoom out, how the market might perform on an average basis looking at 10 or 20-year time frame. So based on history, I think it's probably safe to say that we can't expect next year to be another 20% plus return year. But here's the thing, back-to-back 3 consecutive positive years with the stock market are actually fairly common. So I would say it's fair to say we could expect more modest returns going forward. Again, this isn't really all that surprising, but there's certainly nothing in history to say that next year is doomed to be a negative year in reaction to positive years. Looking back over the past 99 years, there have been 74 positive years and 25 negative years. And these positive years tend to cluster. The longest stretch of positive returns is 9 consecutive years. And if we speak in terms of averages, the average bull run goes for 4 years before the market posts a negative return year. History has shown us that our markets are very resilient, and we are often blessed with extended streaks of positive returns. And one key fact that I like to hang on to in good times or bad is that there has never been a 10-year period where the stock market as a whole has posted negative returns. No matter when you began investing. Investors who have held on to their investments for at least 10 years in the S&P or the market as a whole have always experienced positive total returns historically. This demonstrates the importance of a long-term perspective when investing in equity markets. The worst 10-year periods in our nation's history came around the Great Depression, so 2029 through 2039, and the years that followed the Great Financial Crisis of 2008. And in the case of 2008, those returns over a 10-year period were just barely positive and only positive once you factored in dividends. My key takeaway from that is to always reinvest your dividends, because dividend returns aren't insignificant. From 1940 to today, dividends have accounted for roughly a third of the S&P's total returns. And while 20% plus returns may sound amazing, and make no mistake about it, they are, they're not as unheard of or rare as you might think. Just look at this chart, and you can see that years where the market posts returns in excess of 20% are fairly common. Do you remember how we've said since the S&P was created, there's been 74 positive years? Well, over 50% of those positive years have posted returns in excess of 20%. I think the major takeaway from this chart is that the extreme years are more the norm. When we're looking at positive years posting returns well in excess of that often quoted 10% rate of return, that's very common. But in the same breath, we can see that those negative years, when they come around, they can be a doozy. But it's because these recoveries are more robust and resilient that the good years so overwhelmingly outweigh the negative years. And with that being said, it might be time to insert the most common disclaimer we've all heard a million times. Past performance is not indicative of future results. I never want positive years in the market to scare someone away from investing. So often when you hear about the market hitting new highs, you start to hear about people saying, I'll start investing, but I'm going to wait for the market to make a correction. That's market timing. And as a long-term investor and as an indexer, that's not something I believe in. And in that same breath, when the market experiences a significant drop, that too can scare people away from investing. And I don't want that either. The narrative at that point becomes, I'll just wait for the market to hit bottom and then I'll start investing. That's market timing. And as a long-term investor and as an indexer, I don't believe in that. What matters more than how the market is performing today is that you build a portfolio that suits your needs. And that has to do with your risk tolerance, your stage of life, and your liquidity needs. Something I always like to bring up when I talk about a portfolio is the pillow test. You should build a portfolio that allows you to sleep soundly at night. And what that portfolio looks like is going to vary greatly from person to person. If you want more stability in your portfolio, maybe you have a paycheck that fluctuates, or maybe retirement is just around the corner. Keep more of your portfolio in cash reserves. However, if you have a really long time horizon before retirement, or you have a really steady paycheck and you can tolerate more risk and volatility, well, have more of your portfolio in equities. How aggressively or how conservatively you should be investing has nothing to do with how the market is performing today, and everything to do with your needs as an individual investor. Only you know what your needs are. Are you setting money aside for a down payment on a home? Do you have kids that are nearing college, and are you planning to help them out? Are you planning a mini retirement where you step away from the workforce? These and a dozen other questions are the things you consider when you are building a portfolio that fits your needs. I never attempt to make a prediction on how the market is going to perform in any given year. My whole philosophy is buy the whole market and stay invested and keep investing no matter what is happening around you, because I believe that long term the market goes up. So what's my prediction for 2025? It's pretty simple. I don't know, and neither does anyone else. But what I do know is that the stock market rewards patience, resilience, and consistency. Whether the market goes up 10% or 20% or even has a down year, history shows that long-term investors always come out ahead. So invest with purpose, build a portfolio that suits your needs and your life and allows you to sleep at night, and believe in the resilience of the market, because long-term, the market doesn't just recover, it thrives. What are your predictions for 2025? Care to leave them in a comment down below? I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. If we've had this exceptional run, now we have a question. Hey guys, let's not forget to say hi. Jeez, please just dive right in. Gotta remember, say hi, it's only polite, right? What? No, that doesn't even apply. Exceptional rules, what's wrong with me? Nope, try again. Okay, I will get this. In fact, I don't want to say in fact. Take it out. Jeez, Pete. First, the years are near. Invest with purpose. I'm going to kill that stupid noise. Oh my God, I'm dying here. I'm dying. Earplugs aren't enough. I still hear it. Sorry, frustration.